Most people think there's a wealth gap in America, but it's not really a wealth gap, it's an asset gap. The top 10% own almost all of the assets, while the bottom half barely own anything. And that's why some people get richer over time, while everyone else feels stuck, even when they're making okay money. Because for a majority of people, it's not a high income that makes them wealthy. It's owning the right assets. You can make 100K a year, but if that money goes towards rent, bills, and your lifestyle, you're basically living paycheck to paycheck. So in this video, I'm going to break down why assets matter more than income and how the system is even kind of built to reward asset holders. To really put this into perspective, the top 10% of households have an average net worth of about $8 million, while the bottom 50% only have around $60,000. And that gap isn't because the top 10% make 100 plus times more money. It's because they own assets, things like real estate, stocks, businesses, things that go up in value while they're not working. And that's where most people get very confused because income does not automatically turn into wealth. Making money and building wealth are two totally different games. From 2001 to 2016, upper income families increased their net worth by about 33%. Middle income families lost about 20%, and lower income families lost almost half. And while all of this happened, the stock market more than doubled. So what changed? It's because upper income families own stocks, whereas middle and lower income families, they didn't. And if you're someone who gets paid on an income and you just save all your money, you're basically just holding cash. And the problem with that is it loses value every year because of inflation. Let's say you've got $10,000 sitting in a savings account earning 1%. But if inflation is running at 3%, you're actually losing about 2% of your purchasing power every year. So yeah, your account might say $10,100 after a year, but that money buys less than the 10K did 12 months earlier. So you didn't preserve wealth, you slowly lost it. And this is why saving money by itself isn't really a wealth building strategy in a system with constant inflation. At best, it's damage control, and that's only if your interest rate keeps up with inflation, which most of the time it doesn't. Now compare that to assets. Over long periods, stocks tend to grow much faster than inflation. The S&P 500 has averaged around 10% a year historically, while inflation has only been closer to 3%. So instead of falling behind, your money actually moves forward. And at the same time, the S&P offers dividends of around 2%. Dividends are basically cash paid out to you as a thank you for holding the stock. So not only is the asset that you're actually holding appreciating, but also you're getting paid real cash to hold. And none of this requires having to go and collect a paycheck. Obviously, if you only have $10,000, getting paid 2% on that is not enough money to pay your bills or to actually spend in a year. But when you look at people who have millions invested or tens of millions, they can use that 2% dividend and literally live off of it. They never have to actually sell the asset when they need to spend money. Real estate works the same way. When inflation rises, rents usually go up, construction costs go up, and property values adjust. So imagine you own a rental property bringing in around 10K a year. If inflation hits 5% and you raise rents by 5%, now you're making $10,500. At the same time, the property itself increases in value. Maybe it was worth $2 million before and now it's worth $2.1 million. The asset adjusted in a way that your cash would never have. And assuming that the rent you're charging, about 70% of it is going towards the mortgage, you're still earning real cash flow in your pocket. It's not just appreciation. Now compare this type of earning to a salary. A salary, your ability to earn is limited by how many hours a week you can work. And it's almost never compounding over time. Maybe you get a 2% raise every year, but you have to be constantly working, and because you never own anything that produces an income, if you do ever get fired, your entire ability to earn disappears. You can also never take your earnings from a salary and try to invest in your salary to make your pay higher. It doesn't really work that way. But assets, especially real estate or stocks, are always allowing you to take extremely low interest loans against them, and you can use that money to buy more of the same assets and keep growing your wealth. And this is why wealthy people, they don't sit on huge piles of cash. They park their money in assets that rise with inflation or beat it. because cash slowly gets eaten away and assets fight back. Now, where you start to see the system really start to reward asset owners is when it comes time to file your taxes. If you make 100K from a job, that money gets hit hard. You're paying regular income tax, and depending on your bracket, that could be 22%, 24%, or even 30% if you're higher up. Then on top of that, if you're an employee, you're paying Social Security and Medicare another 7.65%, and technically your employer pays the other half, but realistically that comes out of what they could have paid you anyway. So by the time everything's said and done, you're losing somewhere between 30 and 45% of your paycheck before you even touch it. Now compare that to owning assets. If you sell an investment you've held longer than a year, that's taxed as long-term capital gains. So anywhere from 0 to 15 to 20%. There's no Social Security tax, no Medicare tax, and it's the same thing with dividends from stocks if you hold them long enough. So if you're in a high income bracket, you're paying close to 37% on your salary, but only 20% on your investment gains. That means that if most of your income comes from your investment gains, you're paying almost 50% less in taxes. And real estate takes it even further. With rental property, you get something called depreciation. Basically, the IRS lets you write off part of the property every year, even though you didn't actually spend that money. So you can be collecting rent every month and still show a loss on paper at tax time. And it's completely legal. And this is where it clicks. The tax code is literally written to favor people who own assets, not wage earners. And it's not some secret conspiracy, it's on purpose. Governments want people investing in businesses, real estate, and markets. That's how they get economies to grow. So they reward that behavior with lower taxes. But the end result is simple. People who make money from assets keep more of their money, and people who make money from their labor give up a bigger chunk of their money. And over time, that gap starts to compound. So what does any of this information actually mean for you? I'm not saying that incomes don't matter. Of course they do. You need money to live, you need money to pay bills, you need money to invest. But income is just the starting point. It's not the end goal. The real goal is turning that income into assets, into things that go up in value, things that make money while you're not working, things that compound over time. Because in a system where inflation is always eating away at cash, letting money just sit in a bank account is slowly making you poorer. And in a system that favors investors, only earning a salary means you're paying the highest tax rates. And in an economy where real wealth comes from ownership, not labor, trading your time for money has a ceiling. You can only work so many hours, but assets don't have that limit. That doesn't mean that it's easy to be successful investing, and it definitely doesn't mean that everyone starts from the same place. Some people have huge advantages, some people are starting way behind. That part is real. But once you understand the difference between income and assets, and you see how the system is structured, it changes how you think. You stop thinking that life is just about a bigger paycheck, and you start thinking about how to turn whatever income you have into ownership. That mindset shift right there is what's going to let you make financial decisions that give you a much better chance at building real long-term wealth.